Hello, dear listeners. Welcome to another episode of the Pursuit of Scrappiness podcast. My name is Ulrich Stadoutkans. I am here with my co-host, Jānis Zepes. Hi, Jāni.
Hey.
Whether you're building a business, running a team, or just starting out in your career, we are happy to bring you scrappy and actionable insights to help you become more productive. Before we start, a quick reminder, subscribe us on your favorite podcast feed, on Spotify, on Apple Podcasts. You will find more than 70, closer already to 80 now, in-depth interviews in our feed with unicorn founders, VCs, and overall very creative and knowledgeable people. So recent episodes feature the CFO of Intel, David Zinsner, Mindvalley founder Vishen Lakhiani, and also OX Drive co-founders Juhan Karma and Ege Gailum. So don't forget to check those out. And today we are speaking with a unique creator, I would call him like that, who has not only created a new training program for investors, an asset management business, a personal brand, a newsletter community, and also some fiction books. So very welcome, Tom Crosshill.
Hi, good to be here.
So now, if we read the taglines on Tom's profile, so currently he's the founder of Crosshill Global Solutions, an online training course for aspiring investors, as well as co-founder and member of the supervisory board at Indexo, an asset management company that was made to challenge legacy pension funds. And today we're going to talk about building a personal brand, also how to start investing and how to invest kind of smartly, and a bit about the global economic and financial situation and what to do in these markets. So starting on building a personal brand, you have become an influencer for investing in Latvia and beyond. So how did you start doing that?
Just to give you a bit of background, I started my career in the financial markets something like 15 years ago on Wall Street, working at an investment bank. In the US, that's maybe nothing out of the ordinary. Many people live on Wall Street. But when I came back to Latvia, it was something out of the ordinary. There are not that many people who have worked on Wall Street living in Latvia. So naturally, maybe some radio shows or newspapers or whatever, they wanted to, ask me about that. So that was kind of a good kind of base for that platform. And then some years later, when a few people approached me about starting Indexo, which is this asset management company that we started in 2017, it was natural. As I started working on that project, I saw that there was, a great lack of information in Latvia about effective investing. And a lot of people had questions and no real way to get good answers because everything you see online is aimed at Americans, right? So I started blogging, and because of my background plus my ability to write, I guess that really took off quickly. What is interesting for me now is, of course, in Latvia, I'm very widely known among people who care about investing. But right now, this past year, I'm moving into Europe and addressing the European market. So now I really get to check, do I actually know something about building a brand, or was that just a fluke? I got lucky. So, yeah.
All right. So your alternate ego, Tom Crosshill, in Latvia known as Toms Kreitsbergs. So Tom Crosshill first showed up on the scene as writing fiction or sci-fi novels and short stories. How has this facilitated your kind of business content creation, if at all?
Well, actually, this is something I talk a lot about when I talk to students, high school students or college students. I remember when I was in college, I had this kind of dilemma. I was studying physics, but at some point I realized that I didn't want to spend all my life doing physics. I liked it. I was really good at it, but I was not really that passionate about it, in order to spend 40 years just doing physics. But I kind of felt guilty and bad because it's like many people tell you that to be really, really great at life, you have to focus at one thing and just do that one thing until you're really great. And I think that's probably true in in many fields, like playing the piano, being a conductor, an artist, or a physicist. But there are many other fields where that is not true. And there are many other fields where it is extremely useful to have various skills. And one of them is entrepreneurship. Because when you're starting a company and it's just you and a few other people, it is extremely valuable if you know how to write something compelling, if you know how accounting works, if you understand how to set up your website and the pixels and everything. Like even if you're not a master at any of those things, but you have these different skills, it is hugely valuable. It's hugely valuable for entrepreneurs and for team leaders, for managers. There are many areas of life where you can be excellent, even if you haven't dedicated your life to one thing, but you've done many different things. So that's kind of my long-winded answer. Writing has been extremely helpful in my business career because, I mean, what drives business? It's sales. I mean, that's fundamental. You need to be able to sell. And selling is communicating. It's understanding the audience and understanding what they need, what they lack, and helping them see how you can solve that. So every ad, every sales script, everything that you write, I mean, that's hugely important. And there, my writing skills have been very useful.
Well, and writing has another benefit, and I think people are kind of thinking more and more about it. It also helps you to structure your thoughts and, kind of become a bit more organized. At least it has helped me a bit more organized when you put thoughts on paper. Is there any kind of advice for other people that sort of what to do, what to practice? There is this massive wave of, let's wake up at 5 a.m. and journal for 3 hours, but like something really kind of maybe pragmatic from
bit more down to earth.
Yeah.
Well, actually, so I don't do the waking up at 5 and journaling, but I have actually been experimenting just this summer with kind of a new morning ritual that that one of my mentors taught me I'm really finding it very useful. It doesn't involve writing necessarily, but I do take a walk for half an hour every morning in the park if the weather allows, or just around the house, and I go through kind of a set structure of things that I have to think about in my personal life, in regards to my health and in regards to my business, and I find that it's really helpful to start every day with this exercise, because sometimes we think, okay, I thought about this stuff like on Monday for the whole week, so that's enough. But in my experience, it's not. You quickly drift away from your decisions, from your priorities, from everything else, and the week kind of takes over. There's emails, there's meetings, there's everything else. And it's super helpful every day to kind of recalibrate, okay, what's my focus today for business, for health, for personal relationships. And I'm experimenting with that, but that is my current kind of morning ritual. Not 3 hours, not journaling, but
whatever works. If 3 hours work for somebody, it's also great. Like I think majority of people, it's easier for them to adapt your tip actually, because half an hour, 10 minutes, 15 minutes, we maybe can find. Cool tip actually, yeah.
I hope somebody can. Well, actually, I'm going to share just a little more. The key to this half-hour idea is it's not half an hour sitting on your butt. Let's put it this way. It has to combine movement. So it's good to walk or exercise or whatever. You can actually talk aloud to really kind of, it helps clarify thoughts, because, when you think about it, you jump from idea to idea, but you have to say things aloud. You kind of have to formulate them. And what is really helpful, I mean, here some people are going to say I'm getting esoteric, but what is really helpful is the third element is that you also look for ways to feel grateful during this morning ritual. Yeah. Because scientific studies show that gratitude really helps in a lot of ways, like make us happier, reduce stress and all these things. So if you, as part of the morning, you can think about what you need to do and also what you're grateful for in your life, and you're moving, you're getting some of those endorphins or whatever releasing in your body. I mean, that's just a great way to start a day. Yeah.
Oh, definitely. I mean, I think for the last 7 or so years, I have like every morning and every evening, I just write down in notes like 3 things on gratitude or like good things that happened. Sounds super silly, but it kind of helps you to put your minds back to kind of what's important. So yeah, definitely can attest to that.
Good one. Yeah.
So back to personal brand building, as I kind of witnessed as many, you showed up on a new, I don't know where did I first saw you. Somehow I got on your newsletter.
I saw you in German YouTube, so you're there in Europe.
So yes. Basically you started appearing in my mailbox, and then you started talking about Indexo. Then you launched Indexo. So clearly this personal brand, and leading up even to the IPO, but clearly this kind of personal brand building, it felt like a deliberate activity that you kind of did. And the question is, so for somebody, I mean, first of all, I guess it's not really a question. It feels like today, if you're going to be in digital business, at least, then you basically need to have a personal brand. You need to have some kind of content around you. That's a must. So, are there some particular ways how you advise people to go about it to really build a personal brand as an expert in any given field?
Yeah, so actually, let me take a little step back. I would not agree 100% that you have to have a personal brand. What you can have if you don't have a personal brand is a really, really good sales team. If you sell one-on-one, you can still sell today and make a successful business without necessarily having a big brand. But if you want to be able to sell through, let's say, ads to a cold audience that doesn't know you at all, and you have no following and no brand, it's very difficult to convince people who've never met you. Yeah, so for that kind of digital business, yes, it is very essential. We saw that. We tried to break into Europe without any brand, and initially there was no response, and now we're getting more and more. In terms of how do you build it, well, I think it's a really, really simple recipe I'm still working on cracking it every day. Like, okay, we started recently. We're not like huge in Europe, but we're making good progress. And what works for us is like figure out what is your audience, figure out what's hurting them, like what's the problem, and figure out like of all the problems they have, like what is nobody else addressing, or not in a massive way. So, for example, for investing, our audience is Europeans, and we really see that they are underserved because in fact, most of the advice online and everything you can find is for Americans, and it doesn't apply in Europe. We have different tax systems. There's almost 30 countries in Europe with different, each has different tax systems, different products, different brokerages, and everything else. Okay, in every country there are some local people doing something, but Europe-wide, they're really not being served. So when we started addressing that in our content, that's where people started responding. Yeah, for example, so we just started on TikTok maybe a month ago, but we already got one video with like 140,000 views or something, which was specifically about this pain point. Other videos might have 1,000 views or 2,000, and then you hit that pain point and suddenly explodes. And then I guess what we think is that we have to pay attention to those pain points, and kind of build on that and give people more of what they need, try to help them solve the problem. So that's kind of the model we're following, and we'll see how it works over time.
But what about mediums? Is there somewhere to start better? Better to start writing or go straight to TikTok, or I don't know, like how do you see that kind of developing?
I expect this probably has to do with like what are you naturally good at? It might be a good place to start. For me, in Latvia, writing was a very good starting place because I'd never had a lot of interest in video and all these things by myself. So I didn't have many like visual skills. So starting to build my own channel or something, it would go very much against what I was good at. But I was good at writing, so I started with the blog. Now, today, I have resources. Fortunately, I can afford it. I had enough capital to start a business. Then now we have income, so we can sponsor it. Now we have a video person working for us. We're about to hire another one. We have a whole team that makes sure that our output looks great. So I just have to come and deliver it. So now it's different. But on the other hand, if you are a kind of a visual person, then you might start with YouTube or TikTok or whatever, and that might be perfectly fine. I think it's important when you're starting without a budget, when you're starting to slow, to kind of figure out what you're good at and what you can do with your existing resources.
I think the thing you mentioned about finding the right audience and niche and whatever you're doing, I think probably niche is one of the things people kind of should start with thinking about. I mean, cannot generalize, obviously, but for you to get to this product offering, maybe you can walk us through just a few steps or like iterations you made, sort of. Did you start with like, okay, we're going to go after whole world and then narrow it to Europe? Or then you understood, okay, there's a specific segment, this age group, this income class or whatever that we're going after, just to understand how you narrowed it down?
Well, I guess I kind of slid into it naturally because So for a number of years, I was building this Indexo business with my partners, and I just got to I did tons of seminars, meeting people, talking about like pension investing and all that. And I saw the kind of lack of knowledge. I encountered that a lot. And on the other hand, I was actually building all the investment systems and investing hundreds of millions of euros. So I was developing all the skills and all the nuances and all the details, that, I didn't know them coming out of Wall Street, because in Europe, again, there are more nuances and details. And so it was natural. I saw that people lack this knowledge in Europe, probably more so than in America. In America, it's a lot easier to find the answers to all these questions. You just Google it and there's 100 articles and videos and everything else. And so I tested the market in Latvia and then started expanding. Now, what might be a useful lesson for other people starting out, I initially actually wanted to start in English, targeting Europe. But halfway through, I had already built half the course, and I decided, you know what, people know me in Latvia. Let me try in Latvia first. And that was like the smartest thing that I did, because when I started out, I didn't have that much capital. Like, if I had failed with a few kind of webinars in Europe, I would have had to do something else. Yeah, I would have been out of money. And in Latvia, our project took off and people really appreciated it and responded. Now, when we went back to Europe, like our first webinar, I don't remember how much we spent, 5,000 or 6,000 euros, and nobody bought it. Like nobody, absolutely nobody. And then the next one, maybe 2 people bought it out of maybe, hundreds that were attending. And of course, then, we got the ball rolling in social media, and there were testimonials because people liked it. And now we're selling okay. We're doing good. We're getting a positive return on investment and everything else. But if I'd started with this foreign market, I would have gone bankrupt before I got there. So if you have some local niche, some group that knows you, if you can start organic without spending on ads, but like using your connections and reputation, whatever, to get some first customers, get some first cash flow to prove the product works, that can be really good. There's a big danger of trying to immediately conquer a big foreign market where nobody knows you.
Yeah, that trade-off, why are you wasting time on these Baltic markets? You go attack Germany straight away. Speaking of working in Europe, so are you doing all English, or you're trying to localize somehow, or how does that work?
Right now, we are doing it in English. I imagine for the next few years, at least, that's going to be the focus. We did look at localization. We tried translating ads and stuff, but we saw that maybe the response wasn't so great. If it's not really native, but it's kind of translated, the response wasn't so great. I know that I can't deliver a good webinar in German or in Spanish, maybe I could. But anyway, it's kind of challenging. And then, so even if you do the sales part in a different language, but then the whole course, I'm not going to translate it in 25 languages. So I realized, let's start with a simple, the usual kind of minimum viable product. Out of the 300 million or however many people in Europe, there's a lot of people who speak English. Whatever the number is, there's a lot of them. So if you can start there, and then, once you have revenue in the millions, then you can pay a team to localize, and it's all doable down the road. But start with the low-hanging fruit.
Yeah, it's something that I have encountered as well. It's tempting, right, to, especially for ads, to localize, but then it kind of creates also this expectation, right? If you're approaching me in Spanish, and then I show up at your website and there's nothing in Spanish, then I'm like, okay, so what's this trickery? So I have been also hesitant to go away. We've tested and with some success as well, but I kind of feel responsible that if I speak to somebody in their language, then they expect both, sales, account management, customer support, everything to be done in that language. So, did you start blogging just for fun, or you had already some kind of business plan behind it?
So it was kind of a mix. I started blogging when we were just starting to build the Indexo asset management company, but before it was public, and it was in response to, on the one hand, seeing how bad things were in terms of what people know and how many questions people have and how difficult it was for them to start investing. And then, of course, on the other hand, I knew that this project was coming down the road, so it would be helpful to have an audience and to have more authority on this topic. So those things came together and motivated me to start. Yeah.
Yeah, I mean, it definitely helped to convert me into a customer. Now I always feel bad for all those direct sales guys in shopping malls that I already am a client, so they cannot add that incremental sale. But final note on Indexo. Many people in Latvia were following the IPO, and I had a question about it because I was a bit kind of torn on what I think about it, because from one side I thought that it's great. We have very, very shallow stock market and any company listing is great. On the other hand, I looked at the prospectus and felt like seems a bit kind of early for an IPO of this kind of size of the business. So maybe you can walk us through why did you actually choose the IPO as a source of further funding? Because clearly it was oversubscribed and successful and kind of is going well. But what was the thinking behind why exactly that?
Sure. First of all, of course, if we compare any IPO with our kind of everyday impressions of what we read in the news about big global companies or whatever, then of course any Baltic IPO is going to be tiny. Now, in terms of market cap, sure, Indexo is pretty small anyway, but I also think a lot of people don't fully appreciate the stage of the company because they just look at the headline numbers in the financial statements and don't look at the structure. So Indexo actually has today around 85,000 clients, €500 million assets under management, and it's actually, before client acquisition, it's strongly profitable. So the pensions business is actually established. It's just spending a ton to acquire more customers, which of course is a typical startup kind of fast expanding story, which is hopefully great for future prospects. Yeah, that's the idea. Now, so from that perspective, I don't really see it as an early stage story. Yeah. And then we come to the next part, which is of course, yes, the pitch was that we're coming in because we want to launch a bank, for which you need an ECB license that's approved by the regulator. There's all these preconditions, but that's the basic idea. You're attracting funding so you can expand in a big way. Yeah, so there you could potentially argue that that's maybe not typical that you would use an IPO necessarily for that. But the way we look at it is Indexo from day one has been all about transforming the local financial industry. Yes, about making a profit, about making a profitable business, but also about transforming the local industry. And a lot of our clients have responded not just to whatever financial benefit, which I don't want to downplay. I mean, what we did coming in with lower fees at the time, provoking competition, all these things that are very valuable, but also because they really wanted to be part of this change. And here we saw that this is another chance to let more people participate in this change story. Yeah? A lot of our clients and supporters really kind of engage with our ideals and what we're trying to do, and this is a chance for them to participate. And finally, of course, we wanted, if you're saving your pension with Indexo, we wanted you to be able to own a bit of Indexo, so it's like you're paying the management fee to yourself, basically. Yeah? So that was kind of our thought process, and of course, we're really happy with how it has gone so far. And now we have to do the all the big work of actually, executing. So that's I'm looking forward to what the next few years are going to bring.
Somewhat kind of could be compared to some crowdfunding, only with the heavyweight approach, not some let's say I don't know what to even call it. These different kind of crowdfunding stories, they can be from complete greenfield to like companies like Revolut or building community. But then what you chose is like this hardline, regulated, heavy way. No shenanigans. Real markets with clear rules. So I think that's something to be respected.
Well, I mean, that's actually so. In the past, I've been publicly skeptical about various P2P platforms and crowdfunding platforms. And the situation is getting better because in Europe, the industry is getting regulated more and more. But I mean, that's been one of my big hesitations why I don't participate in crowdfunding, because a lot of these platforms and a lot of stories, they're either sloppy or outright scammy. I mean, there's not enough oversight, there's not enough clarity, and there's all kinds of conflicts of interest and everything else. Yeah, when you're doing an IPO and you're doing an IPO of a licensed business which wants to get another license from the ECB, permission to launch a bank. I mean, there is so much regulatory oversight that I think for me as a shareholder, that also gives me extra comfort. Yeah, that it's not a black box.
So to become a shareholder, you have to start investing. So I think that's a decent segue to move into the next segment of how to start investing, whether to jump in participating in an IPO, a peer-to-peer platform, or crowdfunding. So what is needed for an average person to start investing?
Well, of course, anything I say in a way will sound self-serving, but in my view, the first thing to do would be to educate yourself a little bit. Doesn't mean you have to immediately run out and pay for a course, but at least, take the time to watch some basics, find some sources where the person talking about it, has some professional background, not just a random blogger, and cover some basics about, okay, how does investing actually work? What kind of returns can you reasonably expect? What can you not expect? What's kind of a reasonable long-term investment, and what's just like speculating, trading, gambling, like these basic things. It's important to understand. It's important to learn that, for example, if you're expecting to make 20 or 30 or 50% per year, that's probably not realistic, and you're more likely to lose. It's important to realize that, maybe whatever it is, 4, 5, 6, 7, 8, 9, 10% per year. Okay, it's not sexy, but it's a lot more achievable. And over the long term, it can still make a massive difference for your finances. It's important to understand that even if you're investing in something that's responsible, like let's say long-term stock investments, there's still significant risk. And when there are crashes, you can, at least in the short term, lose significant amounts. It's important to understand these basic things because, of course, it's not difficult to just find a video and learn how to click buy on Tesla or Amazon or an index fund or whatever. But the question is, what happens next? What happens when the market goes up or when it goes down, when you get scared or when you get excited, and when you need to take some money out and whatever, like and you start making mistakes and you start doing dumb things and you start getting, and then you get disappointed and you tell everybody that investing is just gambling because, you lost some money, you don't understand why. So education, I think, is the first step. You need to understand some basics. Once you understand the basics, the next step would be you need a bit of a safety cushion. Mm-hmm. Generally, it's not the best idea to start investing with your last money, or if you have expensive credit card debt or something. I mean, first pay that down, then save up enough so you could live for a few months if you lose your job, for example, without needing to touch your investments. And then once that is in place, then you can actually start to make your first investments. Okay. On the one, I know from one perspective, it can be a little kind of disappointing that, it's not just click and go. But on the other hand, I always encourage people to think like you're setting up a system, an investment system, which ideally is going to serve you for decades. Yeah. Every euro that you make in your job, you can, or that you save, let's say, from your job, you want to invest it to protect it from inflation, to make it grow for years and years and years. So it's okay to take a few weeks or maybe a few months up front to learn and do it properly so that, for years and years, you're going to get a good result and you're going to have some confidence about what you're doing, as opposed to just doing something at random and then later freaking out.
Yes, but I guess also, as you know, that's practice also is where you get the best education. So I'm not convinced that you can without any background. I mean, the area of topics that you covered in like a minute that you mentioned or 2 minutes, it's so wide that if you start out without any kind of understanding or education in this, I think it can become overwhelming pretty fast. So the question is whether it makes sense to just, try out a bit, feel what it's like when your just acquired Coinbase stock went down 30% the previous day. So
yeah, well, I think there's different ways. I mean, in my experience, if you follow kind of a structured approach, you can learn it step by step. At the same time, a lot of people do learn by experimenting, and that is okay. But then it's important to keep your expectations low, kind of do it with play money. That is money that you're okay with kind of losing, and start slow, as opposed to I got an inheritance. Like I've had people write to me, so okay, I got an inheritance, like my family's savings, it's now 20,000 euros or 30,000 euros, whatever, and I'm thinking, should I buy Bitcoin? And again, I'm not here to hate on crypto, but this specific kind of question, it's kind of scary. It's maybe not the way, if you have kids and family, that you should approach your personal finance. Yeah. So if you want to start experimenting, start small and with amounts that you can afford to lose. And then as you get more experience and you understand more, of course, then you can increase that.
What are some of the mistakes you see? Because also in Europe, I think you picked a good market. In one of the previous episodes, we discussed like the stock market participation in US and Europe. These numbers were super different. Like US was almost
staggering difference.
Staggering. Europe was almost no one. US like 40, 50, whatever. I don't remember. But let's say somebody who's just starting. What are the things you see? Like the things you mentioned, like expecting too generous returns, obviously. Maybe something else as well. Some mistakes people make.
Well, I would actually maybe not start with the mistakes. I would start with a step back, which is a question of motivation. Why is it that Americans, for example, invest and Europeans don't invest? Now, I've lived in America, I've lived in Europe. Maybe I have some platform to compare. So there are many things that are messed up with America from a European perspective, right? A lack of a safety net, wealth inequality, like many things. There are you could talk all day about
lack
the things
of
that
physical
up,
safety.
Right? But exactly, yeah, all sorts of things. On the flip side, so in Europe, in most of Europe, for example, we have these kind of generous state support systems. They are comparatively generous. Of course, in the Baltics, in absolute numbers, the pensions or whatever are really low. But on the whole, if you lose your job somewhere in Europe, in most countries, it's not like a kind of really kind of panic sort of situation. You usually have enough time to figure out what's going on and everything. Like there's a lot of kind of support, and there's often a sense that, it's going to be okay. I can kind of, one way or another, whatever happens, I'll keep on working. I'll find a new job. I'll collect unemployment, whatever. And my theory is that that's great from one perspective, but it also kind of lulls you into the sense of complacency, and maybe there's less motivation, less of a kind of a feeling that you have to save, you have to build up your own capital. So when it comes to motivation, one way I think about it and talk about it is, from basic like economics, all the income that's generated in our economy, it goes to like three things. It goes to either labor, there's people who are earning a salary or whatever, getting paid, or it goes to land, or it goes to capital. And I don't remember right now the exact split, but it's somewhere around half to labor and half to everything else. But the problem is that the people collecting the labor part, that's like 8 billion of us, right? The people collecting the other part, there's way fewer of them. So if we work 9 to 5 all our lives for just a paycheck, well, basically we're helping generate this global income and global wealth, half of which is going to end up always going to the people who own the capital and who own the land. And it kind of, to me, I'm not okay with that. I don't want to live like that. I also want to get a little bit at least of the other side, right? I don't want to have to work for somebody else all my life, 9 to 5. I want to also build up some capital, not because I want to be some kind of, billionaire who's lording it over everybody else, but, at least to keep, hold my own, at least, for it to be fair. Okay, yes, I can also participate in this global economy. I can also own a little bit. I can also get some passive income. I mean, that's maybe a more philosophical way of looking at it, but that's something I've been thinking about recently. One way to think about it. Like, do you want to just work for somebody else, or do you also want to participate in the other side of the equation, the other half of the global income distribution? Let's put it this way.
Well, and
something between billionaire overlord and Marxist revolutionary. So somewhere in the middle.
Yeah. Well, one
I sometimes say that I want to be a little capitalist. My business partner tells me not to use the word because in Europe everybody is like, oh, capitalism, that's horrible. But that's kind of my attitude. Like, not a billionaire, but a little capitalist. That's fine with me. Yeah.
But one thing is also, I think people don't, especially those that are not exposed to mathematical fields of study, they don't. And it's hard for our mind to understand, for example, how compound interest works, and that small things over time, they're not like linearly growing. It's not like, €5, €50 every month. It's like, the bigger capital you put aside and the longer time you have, and actually the importance of having long time. So if you're starting investing at 77, then, well, maybe it's, you better shape up your health for another 70 years. Any examples how you have explained it to some of your seminars, people, how much you can actually, by just modest and pragmatic saving over time, what you could get out of it, like some maybe just examples to illustrate the benefits?
I'm not going to exactly talk about exact numbers. Like,
this is not a financial
million.
This
right?
Is not a financial advice.
One story that I always tell is like my own impression of this. I was just starting out on Wall Street, and I wanted to invest. I wanted to start investing, but before I figured out how to do it, because in the beginning I was a physics graduate, I didn't actually know anything about investing. So before I could figure it out, the global financial crisis started. So the markets collapsed, and my bank was firing people, like thousands and thousands of people. I was scared I was going to get fired, so I didn't invest. And I was telling one of my colleagues that I was almost kind of proud that I kind of, that I didn't make the mistake before the markets started falling, and that I was going to wait for the markets to come back. And he called me an idiot. So the way he put it is that, like he'd been in the markets for 30 years, these rises and falls, they happen all the time, but he just like invested regularly, and he'd been making like 7% per year on average. And of course, when I heard that, like 7% per year on average, I was thinking, okay, so I had $10,000 saved maybe at that point. So that's $700. Well, yay, that's super exciting, right? So it's like, I mean, like, is it really worth it? Like 7% per year, like all the stress and worry and everything else. And of course, he looked really annoyed, and he told me that like, you probably didn't study any math in school, because 7% per year doubles your money in 10 years. Yeah, and of course, I did study math in school, but as you said, it's like all abstract until you actually meet it. But yes, I mean, 7% per year doubles your money every 10 years. Now, of course, on the one hand, 10 years is a long time to wait to double your money. But on the other hand, think about it. Let's say over the past year, whoever is listening to this, like, let's say you saved €1,000 or €10,000. Like, how much effort did it take you? Like, how many hours at work or working on your business or whatever? Like how much does it take us to save 1,000 or 5,000, 10,000 euros? Like, isn't it worth it if we can over time double or triple that? Okay, sure. Making it like 50 times bigger, you have to be super lucky. That's gambling. But double it, triple it, quadruple it over the years, as opposed to letting inflation eat half of it. Yeah, I mean, it's a huge difference for how we're going to live later in life. Yeah. So I think it's really kind of, I was lucky that I switched my thinking early on, that I understood this difference. Okay, instead of chasing riches and trying to like time the market and guess the right time, you kind of invest regularly, and you try to go for these achievable rates of return, so that you can protect your money and grow it over time, and kind of, trust compound interest. Another useful story, not a story necessarily, but another useful thing is sometimes to read American newspapers, because in Europe, like I didn't grow up, when I grew up, I didn't know anybody who was investing. And I think it's the same for many of us. But if you like talk to Americans, or if you read these newspapers, you will quite often see these stories of like this secretary died a millionaire and everybody was surprised, but she had been saving whatever 30% of her income and just buying index funds or whatever, or this janitor died with a few million or whatever. Now, of course, it's not my goal to die with a few million, but I think it kind of, like when you see these stories, you kind of understand, okay, yeah, over time it works. So if I'm going to save and I'm going to invest, it actually works. It's not just abstract. People can actually do it. Yeah. So that the belief is really important that it's possible. And once you have the belief, once you have the motivation, then it's actually like the practical details. And it's just a matter of kind of studying, finding the information, going step by step.
But that mindset shift is, I think, very big challenge. So you really have to own that thought, right? Own that idea that, okay, let's do this, and this actually is valuable for me, and I will be more disciplined with my spending, and we'll make something happen. Maybe there's some books that not maybe give you like very technical advice, but just inspire to switch to this kind of lifestyle.
Again, I'm going to take a step back because so there's this whole FIRE movement, the financial independence, retire early movement, which is all about like save as much as you can and invest and then retire.
At 33, where you can retire
and you really save and scrimp and live kind of a restricted lifestyle, and that motivates a lot of people, but it doesn't motivate everybody. It doesn't motivate me necessarily. So the way I look at it, that's one way you can go about it. Okay, you can say, yes, I need to really restrict myself to save a lot so that over 20 years I will accumulate a lot. The other way to look at it, if you're an ambitious person who wants to, grow wealthy, is to understand that there are several parts to the picture. It's not just about saving and growing. There's one more part. It's not just about saving and investing. It's about making money. So the real equation is make more money, and then don't spend all of it. Save a big chunk and invest that. So people go wrong when they expect investing to make them millionaires. Investing doesn't make millionaires unless you get super lucky. Making a lot of money, or unless you wait for 40 years. If you can make a lot of money in your work, you develop your career and you get high income, or you start a business, you make money, then you don't spend all of it. Don't immediately buy 3 Teslas and a nice house and everything else, but save a meaningful chunk of it. And then you invest it. I mean, that's how like you can really grow your wealth without necessarily having to live a very restricted lifestyle. So there are different ways to go about it, because I think for a lot of people like me, I don't wanna, for the next 10 or 15 years, not spend. I'd prefer to work really hard, make a lot of money, not spend all of it, save a big chunk and make money. So that's kind of, so people have two models. Yes, you can, kind of scrimp and save for 10, 20, 30 years, or you can really focus on the whole equation, really work to increase your income, save and invest. Now, coming back to your question about books, actually, it's maybe not exactly about the saving part, but my absolute kind of favorite book on investing is the Little Book of Common Sense Investing by Jack Bogle, who is kind of the pioneer of index funds in the US. So that is, I forget if it's the little book or if it's the little red book. The book is red in any case. I guess it's the Little Book of Common Sense Investing. Jack Bogle, a really, really fantastic book, a really, really good, a really simple explanation of how index investing works and why it's a good idea and how it can make a big difference over the long term. So that's what I really recommend. Yep.
So we'll double ask that question as you went the other way. So are there any common mistakes that you would mention that people make? So I guess we touched already on some, throw all your savings in the riskiest asset. Maybe some more kind of less obvious mistakes that people make.
Well, the first and most fatal mistake is delaying and delaying and delaying. And, we're all busy and we have 100 projects and we have family and everything else. So we keep delaying when we're actually going to start investing. We don't calculate how much that costs us in opportunity cost. And if you're young enough, a lot of time, the opportunity cost is bigger than what you're making in the project that you're working on. Yeah, it will be much better, because if you keep delaying, I mean, you can delay for years. I have many students who delayed for maybe 5 years. They didn't invest. They wanted to invest until they took my course. And it was kind of a push for them to start investing. Yeah. But whatever, you don't have to take my course. But if you notice that, okay, you've been thinking about investing for years, just tell yourself, okay, stop, do it now, because the opportunity cost, I mean, one day doesn't matter. 1 month doesn't really matter. But if it adds up and it's a big difference. The other kind of typical mistakes for Europeans would be maybe trying to copy some advice from American blogs or something. There's a number of mistakes. They try to buy American ETFs, which are not available in Europe. Then they get frustrated. Or they just want to buy the S&P 500 without realizing that there's actually, there's a lot more to the world than just America. There's different kinds of, stock markets and everything else where you can invest. They screw up their brokerages. They choose the first brokerage they see, which is really cheap, without thinking about, let's say, safety or tax impacts or customer service or all these other aspects that are important. There's kind of a laundry list, and here I'm going to make a little pitch. So if you want to know, what are some of the most dangerous mistakes and some of the things to do and not do as a European investor, I would really recommend following our channel, which is Index Investors, either on YouTube or TikTok or Instagram, or coming to one of our free webinars, which you can find at go.indexmasterclass.com, where we kind of really go through these issues. That's kind of our main topic.
Yeah, definitely. We'll put a link up in our channels as well, because I think it's kind of really valuable thing you're doing in that area. So we're happy to help and promote.
All right, and the final topic that we wanted to cover, so the current global financial economic situation. So U.S. stocks over the past 6-12 months have down a lot, growth stocks, even big tech. Do you believe that we are out of the woods already, or there's more to come with all of the Fed tightening that is ramping up? And so, what do you see? What's happening out there?
Yeah, so this is one of these questions where I'm not going to give a satisfying answer. And that's actually something I talk about a lot, both in our courses and our YouTube and everything else. Like almost all of the opinions about what's going to happen in the market next that you will read on, like in serious financial newspapers, they are just garbage and not worth reading. And if you read them closely, they typically they include words like, the market might go up because this or that, or it might keep going down, or it might not. This could be the bottom, but it could not be the bottom. The truth is they don't know. Market timing doesn't work. It's been pretty much proven. Trying to predict what's going to happen in the next 3 or 6 months, that's a Robert C. Merton, Nobel Prize winner, said it's a fool's errand. So I'm not going to sit here and try to predict what's going to happen with the market. What can be done is, yes, we can talk about the factors that are kind of influencing the current situation. Of course, it's an interesting situation. We had big inflation driven by a number of factors, many years of this kind of very loose monetary policy. Then you have the pandemic with the supply chains locking up. Then you have the war, the Russia's attack on Ukraine on top of that, which is disrupting all kinds of markets and logistics chains. And so you have the inflation pressure. Then you have the central banks trying to respond to that, trying to control inflation without crashing the economy. You can talk about that, and it's a very interesting discussion. But then trying to get some kind of investment insights from that for the short to medium term is usually garbage. It's usually not useful. What the research shows again and again is the smarter approach is that you consider your goals, you consider your risk tolerance, you make a portfolio that's in line with that, and then you invest regularly without trying to adjust these for these short-term events, because more often you will screw up and do something wrong as opposed to reacting correctly. Yeah, our emotional biases and everything else predispose us to do all kinds of dumb things, because the markets are so difficult to predict. It's just not a very smart thing to do.
So your advice would be, no matter what happens, no matter how hard things are going up or down, you just stick to your basically strategy of regular investing and basically don't try to be smarter than you are. Or
Okay, so I can't give investment advice. You need a license for that, and you will need to talk to a specific person. And there are certainly circumstances. I mean, everybody has to control their circumstances. You have to understand, am I taking risk that I can afford to take? Do I have my safety cushion? Is my investment portfolio in line with my goals? If I'm investing for 20 years, sure, I can probably take a lot of risk. If I need the money in 3 years, well, I can't just have 100% in stocks and then watch it yo-yo up and down. That's not very responsible. So there's a lot of factors. But like from a classic index investing perspective, like assuming somebody is investing for the long term and they're a typical investor who has a high risk appetite, then typically it's a smarter idea just to invest regularly, no matter what the market does, in a diversified way, than trying to react to short term to what is happening in the market. I always teach people to ahead of these troubling times, to even emotionally prepare themselves, to imagine that your portfolio is down 50%. Because if you don't do it, I mean, one day it might happen and you will be in a very tough spot. But imagine that, prepare yourself for that, understand that it might come, decide, are you okay with that, with the level of risk I'm taking? How am I going to react? How am I going to keep going? Prepare for these things ahead of time, and then it's a lot easier. For example, even though for myself, I have very large amounts invested in index funds compared to my total net worth, I really don't I don't lose any sleep over it right now. I'm not lying there in bed worrying about is it going to crash 30% or is it going to go up? I don't care. I care in a sense, but I don't really care on a day-to-day basis because I'm investing for it's a long-term investment. Excuse me. Sorry. It's a long-term investment for me. And I anticipate that there will be periods when it goes down, there will be periods when it goes up, and that's part of the game, and I'm prepared. The problems start when you're not prepared, when you don't understand what you bought, when you read a blog, you bought something and it falls 50%, and you yell at the world, you tell, or what happens usually, the people who read the blog are okay, but what the biggest problem is that people go to their bank and trust whatever advice they get there, which is usually to buy the bank's investment funds. And then when there's a crash and the fund naturally also goes down 20 or 30 or whatever percent, then they're super angry at their bank and they think it's all a scam and everything. While in fact, they simply didn't understand what they were buying. They just trusted somebody without understanding what they were buying. So that's why it's important to educate yourself. And then I think these times are much easier to navigate.
Yeah, this reminds me of these news articles that BlackRock has lost 1.5 trillion or how much dollars in the last quarter, this half year. And there's if it owns 10% of the whole stock market, then obviously it's gonna lose a lot of money if everything goes down. So
I mean, there's a lot of financial illiteracy in the press, or maybe they're just doing it for clicks. There's tons of articles about how many billion Jeff Bezos or Elon Musk has lost or won, and it's just such nonsense. I mean,
those guys probably didn't notice that they lost them.
Well, if they're smart, they're not paying attention to the kind of short-term fluctuations. The market went up, it went down. Yeah, that's not really meaningful. Yeah.
So we have to quote Ali G and say, educate yourself about these matters.
Exactly. Yeah.
Do you look also at other asset classes, or it's primarily basically index funds? Or because it's just interesting that, for example, real estate, right? Stock markets have gone down, real estate has gone up still everywhere, pretty much in the Western world. So kind of also waiting for the other shoe to drop. Are you doing anything in that area as well, or no?
So again, first of all, we shouldn't really try to predict necessarily what's going to happen in that market. It's not that simple. The shoe might drop or it might not drop. Because, when you have a lot of inflation, it might be natural for real estate to go up just because it's going up with inflation. Plus, people are looking for somewhere to kind of to lock up their money in something real. So that's just such a complex market. We shouldn't reflexively just remember the last crisis and assume that the same thing is going to happen next time. It might or it might not. But in terms of asset classes, so what I usually say is that there's really only 3 big asset classes which really make sense for long-term investors. One is business, so it's either stocks or private business. Another one is lending, so it's bonds or loans or whatever, some kind of lending. And the third big asset class is real estate. And I think it makes sense to look at a lot of them. Real estate for beginning investors, in many cases, in my opinion, is not the most convenient. Because yes, there are some products and we teach them, for like real estate ETFs and stuff. But that's not a direct investment. You're still going through the stock market. But if you want to directly buy real estate, okay, so you need to manage renters, you need to manage repairs. You have calls in the middle of the night because of pipe burst. You have all these things. And it can be annoying, and it can also take away focus from the rest of your life. And if you love that, that's great. But for a lot of people like myself, I don't want to have renters who can call me in the middle of the night. Of course, once you're rich enough, or if you find the right kind of structure, and if you find people you trust, they can manage the portfolio for you. There are solutions around that, but it's more difficult to diversify all these things. Yeah, which is why it seems to me that for most beginning investors who want to invest passively, starting with the stock market makes a lot of sense. But then, yes, as you develop, as you have more wealth, and as you have, of course, also get more of an understanding of how investing works and how business works and everything. Real estate can be very, very attractive. Now, lending, the third asset class, it's also interesting. It's had a very difficult time with all the low interest rates that we've had. But of course, now interest rates are starting to go up. In real terms, after adjusting for inflation, lending is still not attractive, but compared to just keeping money in your bank account, it might start to get interesting again. Yeah. So bonds and stuff is an area to watch and maybe think about.
All right. Yeah, it sounds like a good way to wrap things up. Thank you, Tom, for sharing your knowledge, and thanks for the work you're doing in educating the societies in Europe and really driving up that participation. So yeah, thank you for all the work that you're doing.
How do people find you and your products?
Yes. So there's a number of ways. You can follow us on YouTube, Instagram, or TikTok. We're Index Investors. Or just go to go.indexmasterclass.com, where we regularly run free webinars which cover kind of the basics of index investing from Europe. Now, of course, full disclosure, at the end of the webinar, we also offer our paid program because, in an hour, we can't cover all the little practical details. But most people who come and even don't buy this, they are still happy because that hour gives a very good big picture overview. So go.indexmasterclass.com. If you want to come to our free webinar, I think you'll find it quite useful.
All
right. Yeah, to our listeners, don't forget to subscribe to our webinar, or what we call it podcast still. Also comes free, and with all kinds of actionable insights and advice. So not financial advice, naturally. Never ever. NFA for life. So see you next week, and thanks again, Tom.
Bye.
Thank you. It was fun.
Bye.